Hello, everyone, and welcome to Schwab Coaching. My name is Cameron May. I'm a Senior Manager of Trading and Derivatives Education at Schwab, and this is Long Verticals and Diagonals. And I think we could say it's official. This is the second toughest market condition that we have seen for the bulls since COVID. So how do we trade this? It's going to be an interesting discussion today. The markets may be at a critical tipping point from a charting perspective, at least to some. So we're going to set that context in just a moment. We're going to be making a trade decision for a new example trade today, managing existing positions. Lots to cover before we get to any of that. Let me first of all say hello to everybody that's already chatting in on YouTube. Hello there, Kevin and Will, Josh, Andrew, Dave, John, Life in the Fast Lane, Ray, and everybody else. Thanks for joining us week after week. We really do appreciate your attendance and your contributions in these discussions. If you're here for the very first time, I want to welcome you as well. And if you're watching on the YouTube archive after the fact, enjoy the presentation. Be aware that you're invited to join us in the live discussion. This is a Thursday webcast series. We meet every Thursday and we kick things off promptly at 11 Eastern. If you'd like to be here in the live stream, we'd love to have you. And I also want to let my live audience know we have, as a special treat always, Ben Watson is going to be hanging out in the chats, answering any questions that I can't get to. Ben's a fabulous presenter, brings a ton of knowledge to this discussion. So thanks for having my back there, Ben. Ben and I would also like to issue an invitation to everybody within the reach of my voice. If you have an account with X, give us a follow there on X. Follow your favorite presenters there. It's the best place to connect with them in between these live streams. So you can find Ben on X at Ben Watson CS. You can find me there at Cameron May CS. But let's get into this discussion of trading in these very difficult market conditions, at least for the bullish side of the equation. Now, as we do that, of course, we need to consider the risks associated with trading. They can certainly be substantial, and that does apply to options trading as well. So bear these disclosures in mind. Options carry a high level of risk and are not suitable for all investors. The information here is for general informational purposes only and should not be considered an individualized recommendation or endorsement of any particular security, chart pattern, or investment strategy. Schwab does not recommend the use of technical analysis as a sole means of investment research. Investing involves risks, including the loss of principal, and any investment decision you make in your self-directed account is solely your responsibility. Okay, so here's what we're going to be doing today. First of all, we have some current example trades going on in our example paper money portfolio on Thinkorswim desktop platform. So what we're going to do is have a look at those. Most of them are bullish. How do you think they're going to look? We haven't seen carnage in an example portfolio of mine like this in a long time. So we need to talk through what's going on with those positions, maybe make some trading management decisions. Then we're going to get some broader context, have a look at what's going on with the S&P 500 and why for some traders they see something very interesting on charts that just happened within this last calendar week. Then finally, we're going to use that information to start to plan a new position for our example paper money portfolio. And I'm going to be throwing it out to my audience to assist me with making some decisions here. Let's get some personal investment in these sorts of decisions. I think that can really help cement the learning. So let's go right to Thinkorswim. Pop in here to our example. So this is the Thinkorswim desktop trading software platform. You can download it free of charge from within your Schwab Online account. Just go to the Trade tab and look for Thinkorswim. But here are our current positions. We have one, it's actually doing just fine. The others, all bullish trades, and just like most bullish trades, not doing so well right now. The combined impact of some of this setback that we've seen over the last 3 weeks has even pushed our paper money portfolio into negative territory for the calendar year. I think that might be the first time. I don't remember. I don't think that we were negative last week. But let's have a look at what's going on first of all, starting with Apple. With Apple, we own a 16th of January 2026 long call, sold a 17th of April 2025 short call. That is a long call diagonal spread. It has a bullish bias for price to go up and get just under the short strike at 250. It's not what we're getting. We're trading actually closer to 215. So if we look at this chart of Apple, Here's where we entered this position. This is last week's trade. And you can see sort of the technical, the logic of the trade here. If you weren't here for that discussion, we were seeing a potential bounce off of an apparent area of support around the 232.5 level, entered on the technical expectation, maybe we rise. That might help our long. As long as we stay below the short, we could get a little double dipping potential opportunity for profit. It's not working out that way. Instead, Apple has a mind of its own, as stocks do. They don't care what we think they should do. They just go ahead and do what they want to do. And in this case, we broke down through that support level, and we've been heading down from here. So how much damage can possibly be done in 1 week? Well, a lot. Let's go back to our monitor tab. So we paid $27 for that long call. It's fallen almost in half. Greg says no stops on these orders. Greg, so stops are a possibility, right? We can enter stops with higher probability trade scenarios. One thing that we've discussed in the past is that entering stops actually dramatically impacts the probabilities of those trades. And with trades like, let's say, an in-the-money long vertical spread, which starts off on day one as a high probability, mathematically high probability scenario, if we add a stop to that, it can serve there are benefits to doing that. But one of the drawbacks is that those stops almost always tilt that from a high probability for profit on that trade to a high probability of loss on that trade. Yep. So we have to be prepared for that. And I've discussed that in the past. I might have to revisit that topic in greater detail in the future or in an upcoming webcast. But in this one, we don't have a stop on it, and yeah, we've paid for it. Right now, we're underwater by about half on our Apple long call, which is reminiscent of our UNH diagonal. But our short call actually has compensated for that to some extent. Right now, we have an unrealized gain on that short call of about $3 per share to set against our unrealized loss of about $12 per share on our long. So what could we do here? Well, we could exit the whole thing and just say, let's stem the bleeding right now. But that long call does have a year left on it. Is it possible that Apple could get a second wind sometime in the next year and go back up, get even above our long call strike and continue higher? That's a possibility. No guarantee that it's going to happen. But I think what we're going to do for this position today, let's roll this short call down. Let's realize what gains we might be able to here on that short call and put on a new position, maybe at a lower strike. So with the stock falling down below this support for now, we'll see if it finds a new support level down here somewhere. Time will tell. And actually, a lot of this may be driven by what the markets decide to do ultimately between now and maybe the next few expiration cycles, right? But how about we take this short call here? I'm going to right click on this. Let's edit its properties and assume that we've already exited. Obviously, we haven't, but I'm going to fade that out because we're making that decision today. There we go. And I think what we'll do, let's see if we can sell a new short call. Let's go down here to today's candle. I'm going to start a new one just above that at maybe the 240 level. Let's carry that out, possibly to the same expiration. One thing I will tell you is we're not going to do this for a credit. Let me edit the properties of this. There we go. So we're going to be moving our strike down. Now what that does is it moves it closer to the current price. It introduces an increased risk that if there's a rally, we may get back up above that. It's still, though, quite some distance above where we are right now. It's also above our long call, so it remains a diagonal spread. But I'm gonna roll that. Let's go to the trade tab and see what we can maybe get for that 17th of April, 240. It's only worth about $1, right? The two, actually, we are going to be doing this for a credit. My apologies. There's a different one that I wanted to talk about. Our Gilead. Probably not going to be able to do that for credit. This one we can do for a credit. Yeah, but if we're able to roll that down to, let's say, maybe $1-ish, our 250 is worth about 38.40 cents. we might be able to get about a 60-ish cent credit on that. So let's do that. Let's go to our trade tab. And I'm going to right click on our short call here and create a rolling order. It's going to say sell calendar. That's correct. We're not actually entering into a calendar. It's just the combination of getting out of a short option, which is a long call, and then into a new short option, which is a short call. Looks for the moment like a calendar spread. But let's leave so if you'll notice here, our order here is to buy back the 250 call that we're currently in. And then since the system doesn't know what we have in mind, let's tell it what we have in mind. Let's maybe stay with the 17th of April, but roll down to the 240 call. And there's possibly that 59-cent credit. Let's say we're willing to settle for 58 cents. Settle for a little bit less of a credit. It can increase the likelihood of a quicker fill. Not a guarantee that the order will fill, though. And look at that. Actually, that's moved to our mid. We might even have to go down to 57 cents. Well, let's click confirm and send quickly. So this is going to give us a max profit, max loss scenario as though it were a diagonal spread. It's not. Instead, we're just looking to close out of the one, get into a new one, leaving us with a credit minus transaction fee. There we go. Let's send this off. And we do need a note with options, commissions are a thing, but let's send this order off. And yeah, it looks like we sold for a 61-cent credit. So let's put that on our chart. So we've now sold right here, sold the 240 call. There we go. And our other call is now a realized gain. Let's edit the properties there. Just make that red just to indicate that we sold to get into something. So now let's move on to our next position. So, oh, by the way, before we move on to that next position, I just noticed, just popped into the chat right now, is a survey link. We don't get surveys in every webcast, so when we see these, it's great to take the opportunity to give feedback if you'd like. But if you'll do me this favor, click on that survey link. If you haven't ever filled out one of our surveys before, they're extremely short. 2 multiple choice questions, a comments box, and a suggestion box. But what I'll tell you is that if you take that little bit of time to fill out that survey, I will take the time to read through all those comments, read through that data. It always helps, okay? So thank you for doing that for me. But let's get into our other positions. Next up, we have Gilead Sciences. This is the one that I was thinking, not going to be able to roll this for a credit without doing something comparatively extreme. Boy, my voice is kind of struggling. Sorry about that. Anyway, but we own a $95 2027 call. This thing has 2 years left on it. The 105 call that we've sold against that is now with the stock at 114. It's about $9 in the money. So we sold that short call for about $3. It's now worth about $9 upside down on the short call, but the long call has doubled in value. So actually this trade net is doing just fine. But when we're only 8 days from expiration on a short strike, what happens to the risk of early assignment there? It goes up. Yep. Assignment risk is always present, even on now the money option. But as we get closer to expiration, particularly those in the money options, there's a greater assignment risk. And you might think, that's okay, it's a covered position. What I'll do if somebody calls shares from me, I'll just exercise my long call. That's probably not the best decision as far as mathematically the best way to manage an exit when assigned on a diagonal spread. If we had called out, that would be short 300 shares of stock. The trader probably would do better to just buy long shares on the open market. Pardon me. Hold on a second. I'm just going to mute myself. But in any case, just buy those long shares on the open market. And if we want to, maybe we sell the long options for their value to help with that trade. In any case, I just wanted to call out assignment risk is up. What could we do about that? Well, we could close out that short, The long is doing well. And if the long continues to do well, it could do even better. And we don't even have a limit on how well that long call can do. There's not this drag being applied by a short call any longer. There's a risk in doing that, though. If the stock reverses course, it starts coming down again. Now we're just surrendering it. As a matter of fact, you see the downtick in the market value of that long call just now. We could lose those profits if we retain the long call while closing out the short. George says, or we can roll. Yeah. So this is what I wanted to talk about here, George, because there is a concept with some logic to it. Shouldn't we always roll for a credit? Well, sometimes it's not easy to do without taking relatively extreme steps, because if we exit this right now, it's going to cost quite a bit. What we'd have to get is at least that much, $8.50, $9 from our new contract. So how can we get a higher credit than the debit we're spending here? A couple of things that we might do. We go further out in time, which can expose the trade while remaining at the same strike. That may be just kicking the can down the road. That contract is still in the money. Assignment risk is still elevated. It's just not as elevated because we're not as close to expiration. And it may be, if the stock doesn't pull back, we might just have to close another one out for a loss. Or instead of going further out in time, we could go deeper in the money, which just lowers the probability of success on that trade. So what if we stayed with the same amount of time but went further out of the money? It's not going to result in a credit. It would be realizing a loss on this short, but it's just introducing a new short option that carries its own potential for loss or profit. That's really, when rolling, don't conflate the two trades as being the same thing. Nope, they are two independent trades with their own risk profiles and their own reward profiles. Wanda says, what was the delta on the short when it was called? I'd have to go back and look, Wanda. I would suspect maybe in the 30 range. It ain't 30 anymore. But let me just show you. If we go to our trade, let's envision the trade first. Let's go to Gilead. Well, another thing we could do, this trade is very profitable. Could we just close it out? Just be done? Do we have to hold on to that long? No. So we entered this down here, bought the long call, sold this short call way up here, and yet we've still gone through that level and then some. So if we're up at this apparent resistance, why is that a resistance? Well, if we go to a longer term chart, might even have to go longer than that. There it is. You can see we've been here before. And maybe some traders are just saying, it looks like we might be up at those historical highs. Maybe it's time to go back down again. That might not be good for that long call. Anyway, we could just close up the whole thing. I'm going to close this one out, though. We're going to be closing that one for a loss. Guess what? Losses sometimes happen. I'm not going to cry over that one because we have a smaller loss on this short call, a much larger unrealized gain on the long, and I just want to give that long some more room to breathe. How about if we go up above this level up here, above these recent highs? What if we sell a new call, not going to be for a credit, up here at the 120 level? And I'm going to carry that out. Let's push that out in time. Let's go out here to April. So closing out this one that's about to expire, moving it up here. There we go. All right, so let's go to our monitor tab. I'm going to right click on this 105 call, create a rolling order, sell a calendar. This one's to close out the 105s. Let's go up there to the 120 strike. But pushing that one out to the 17th of April, it is for a debit. Yep. Going to cost us some money to do that. That's because we're spending more to get out of this one that's way in the money with 8 days to go than the one that's out of the money with, what is it, 40-ish days to go? But what's the advantage of doing that? You might think that doesn't make any sense. Well, we've just removed this floor that's been placed. It's now a floor. It's actually a ceiling on how much we can make on the long, and we're moving that up. Okay. So there are commissions to be considered here, but let's click send and see if we can get a fill there. I'm just going to let that one work. We'll come back and see if that one fills. No guarantee that it'll fill. We'll see. Might have to deal with that after the webcast is over, but at least we got to talk through the logic of the move that we've made. JPM is another trade that's kind of broken down. It's another one of our bullish trades, and bullish trades when we get a severe market correction. And severe, I'm going to qualify as this is one that only happens about every year or two. In any case, yeah, JPM has followed that right on down, and it's moving toward max loss territory. I want to talk more about this one next week. This one still has some time to go. We'll see if it has a chance to recover. But what about Microsoft? Microsoft, Ed, you're saying you would have closed one contract for a profit first? Yeah, Ed, could we have managed different, like if we have multiple contracts, could we exit some of one and hold on to all of the other? Things like that. Yeah, lots of different ways we might manage a trade. But with Microsoft, we're in 10 contracts, 8 days from expiration. We got into this trade for about $4, hoping to turn it into $5. Nope, our $4 has now turned into 85 cents. This is a stock that has fallen pretty hard. So we'd like to be up here. Where we don't want to be is down here, and that's where we find ourselves, and we're right against expiration. Now, we could hold on to this and see if it recovers and gets back up above the 400 level. That's just not very probable at this point. And there is still value in this trade. It might be only 82 cents, but 82 cents is $82 on one contract. It's $820 on 10 contracts. And we have a high probability of losing that $820 if we don't do something right now. So I'm going to right click. I'm going to create a closing order, and I'm going to exit this entire Microsoft position, realizing losses, but sometimes losses are what happen. And we might only be able to get 80 cents at this point for this. But let's close out for 80 cents. That's going to be our limit. Let's see if we can get it filled. Let's click confirm and send. Selling those 10 verticals, 80 cents, max gain, max loss. This would be if we were entering a new trade, opening a position. We're closing a position, so we don't worry about that. But there are commissions, so we'll note that. And I'm going to send that order off and see if we can exit there. Okay, so where is that looking like it's trading at the moment? Yeah, we're looking for an 80-cent credit. It's trading at 85. Yep, we filled at 86. So Microsoft, the damage is now done. It's realized, but at least we were able to retrieve $860 from that, minus the the commission that was paid. Is that $3? Yep. Greg says, why not roll on Microsoft? Well, Greg, if we were still bullish on Microsoft, and I think you might be saying roll into another bullish vertical further out in time. Maybe this trader is just saying, you know what, this is no longer a bullish idea. This one has failed. Sometimes failure occurs. And rolling bullish trade after bullish trade in a persistently bearish trend can stack up losses. So it's a good question. So we're going to leave it that way. Now we have a final position, UNH. UNH is a diagonal spread. We bought into a long call some time ago for 102. It's trading for about $70 right now. I'm doing some rounding just to talk in round numbers. So this looks like it's getting hammered. Well, it's lost some money, but it's not as bad as it might appear. We have some history with this one. So with UNH, we bought that 520 call, and the premise here was we were kicking off 2025. What would happen if we just took a position, we stuck with it all year long. How could we do with that position? Well, when we first bought this long call, we sold a 560 short call against that. We've actually rolled out of that one for an 860 profit, that short. We rolled into a 550. We're out of that one for a 670 profit, 672, into a 540, out of that one for a 370 profit. And right now we're sitting in a 530. So actually there's about $19 of now realized gains on the short positions. Our long is down about, what was it, about $32, maybe $33. So is it net profitable overall? No, but it's not, we're not actually down $3,300. That's just on the current positions. On previous positions, we've already realized $1,900 of gains. So we're actually about $1,400 underwater on that one overall. And that can show you how these short positions can, when things go south, it can kind of buoy up that trade. And over the course of the last couple of weeks, we've actually been in recovery mode for that long call, and it has a long time to work. So this thing still has 2 years on it. So we'll see how things go. But yeah, it's relatively speaking though, that's some carnage, right? That's the phrase I used earlier. We haven't seen anything like this in one of our webcasts because the markets have been so cooperative. And that really puts an exclamation point on making the decision bullish versus bearish. So let's add a new trade. And with that as our backdrop, with that sort of experience that hopefully we're emerging from as our learning experience, let's look at the S&P 500. S&P is down, down, down. Last 3 weeks have been tough for the bulls. But why do I have these lines on my chart? As a matter of fact, let's go to a 3-year chart of the S&P 500. I'm going to keep it on a daily chart. What in the world is going on with these lines? Well, I think that there are going to be some technicians out there who study charts carefully, and they may have noticed that within this last calendar week, the S&P has officially dipped into what we call correction territory. This is the second time we've seen a correction since COVID. And so this happens to be the second biggest sell-off since our COVID lows back here in September of 2022, October of 2022. So if I point at this, we can see, actually, let me give myself just a little bit more space here. Let me change my right expansion settings so we can fit this in. There we go. I want you to be able to see that label. But we're down just a shade over 10% on this sell-off. Well, we were down a shade under 10% back here from July to August. That was a 19-day sell-off. We're now on day 20 of this one. And back here, starting in July of 2023, and finally terminating in October of 2023, down a little bit over 10%. So what might this mean for a trader who's planning a new trade for a portfolio right now? Well, some technicians may be thinking this could be an important sort of a fulcrum point for the markets. The last 2 times we've been down this distance, that set the stage for a strong move to the upside. So if our trader had decided, hey, we're down 10%, maybe we're going to go down another 10%, and they put on bearish trades, that proved to be most likely a highly unprofitable decision the last 2 times. Doesn't mean this is going to be what happens this time. But what do you think? Let's make an important decision. Let's make an important decision. Let's plan a new trade. Let me switch up my right expansion settings again, now that you've seen that. Going back to a 1-year chart, let's plan a new trade for that April expiration. But is it going to be bullish or bearish? Go ahead and chat in your thoughts. Do you think that this sell-off, which maybe it seems to be largely driven by tariff concerns, largely driven by economic concerns, Could those things persist? And could this sell off further? Or do you think the majority of the bleeding has already occurred and that there's greater upside potential than downside potential? What do we think? Should we do a bullish trade or a bearish trade? I've actually prepared examples in either direction. So I'll let you comment in here. We're going to be sharing some of the responsibility. It's just paper money. It's all for learning. But I think that making those decisions and then experiencing the consequences of decisions is an important learning experience. Okay, so we've had a few chats come in. Jay says bear, JB52 bearish. Amy says how long? April, Amy. Ambrose says bullish. Leon's calling for more bleeding. Bearish, bullish. That's interesting. There's kind of a split here. Well, let's do this. We already have some bullish trades. We'll do a bearish trade because if anything, it allows me the opportunity to just talk through that. We can do a little bit more learning for those that have maybe only been seeing bullish examples for a while. Let's do something bearish then. Okay. So if we're going to do a bearish trade, let's structure one. And I have a couple of symbols here. Let's first of all look at Oracle. Now, with both of these, a consideration might be the liquidity of the stock. If the stock is illiquid, its options are probably going to be illiquid, and that can lead to pricing and issues and make them harder to trade profitably. Price per share can be a concern, but for some traders who use charts for the planning of trades, they might look for technical developments on a chart. So let's see what's happening with Oracle from that charting perspective. Oracle had this nice gap up on an earnings announcement for the bulls there that set things off for a nice run to the upside. But since then, we actually had what we call an island gap reversal right here, leading to a sell-off. And now we've re-entered this gap, broken down through a price floor that held for about 6 months. Now, there's been an attempted recovery here on this earnings announcement. But interestingly, where did we top out just yesterday? Right at that previous support. So there's one, let's say our technical trader might suspect we're going to bump our heads against that ceiling and run down from here. Or let's look at another one. Neha says, how do you shortlist these stocks for placing trades? So yeah, so technically is a big deal. That really helps to sort of separate maybe the things that look like they're behaving more bullishly from the things that are behaving more bearishly. A quick thing that I'll sometimes do is come up here to the Market Watch and go to Visualize. And I use this right up here, the Index Watch, to look through the S&P 500 companies. And I can see which ones are doing well and which ones are doing poorly just today. See that? Adobe's having a rough day. Intel's having a great day. Tesla's having a rough day. That's actually how I found these ones. So how about one more? Lowe's. Lowe's, very similar, had a previous support level that's held for months, broke down on a big red candle, and it's really just sort of chugging lower. Maybe might be pointing down to these previous lows. It's covered a little bit more distance than Oracle has since breaking that support. But there are a couple technical setups. Which one do you think we should trade on today? What do we think? Lowe's or Oracle? Neither one are guaranteed that they're going to turn out to continue bearishly, but okay, we see me go 5150 says bearish Lowe's. If it's helpful, I can bring up Oracle again, just so you can see that one more time. I'll get rid of my drawing here if that's biasing the input. Lowe's, looks like we've had a few more. Yep, all right, so that was 4 quick votes for Lowe's. Let's go place a trade on Lowe's. So with this, in this webcast series, we talk about long verticals and diagonal spreads. And some people sometimes say, hey, Cameron, how come you did not do an iron condor on this one, or just do a long call on that one, or maybe there are all sorts of other strategies that we might do. In this webcast series, we just limit ourselves to a couple of strategies. long verticals, bullish or bearish, long diagonals, bullish or bearish. And today I think what we'll do is a bearish long vertical spread. So we're going to do a long put spread. So actually, let's go back to our chart of lows for just a moment. With that breaking down, boy, it is a big red candle here. I wonder if we could structure a trade. Looks like there was maybe an intermediate area, a subsequent area of resistance and support right through there. I wonder if there could be a trade constructed that will benefit as long as we're still below that level at expiration. That would be 230. So let's go have a look at structuring a trade around that. I wonder what a like a 240, 230 put spread might look like. So here's what we're going to do for today's example trade. Let's make this bold. Example trade. We're going to do a bear put spread. Oh, we just filled that diagonal. Okay. All right. Well, a bear put spread is constructed by buying a put and then selling a lower or less expensive put, lower strike, less expensive put. So for this example, let's maybe buy the 17th of April. That was the time frame that we were reviewing, that we were planning for. Let's buy the 240 put. And that looks like that's trading for around $19.15 to $20. Let's see if it costs us, let's say just $19.50. We don't know. We'll find out. But then let's also look to sell the April 230 put. And that's going to retrieve a credit for us of between 12.10 and 12.45. Let's sort of split the difference and say that we get, let's say 12.25 for that. So here's what we're doing. We're net spending some money. $19.50 is what we're spending. Looking to bring in a credit of $12.25. That would be $7.25 if we fill for that price. That would be the theoretical max loss. The investment here is how much we can lose. But what is this $7.25 getting for us? Well, we're spending $7.25 for this net deal. We have the right to sell shares to somebody for $2.40. Someone else has the right to sell shares to us for $2.30. Now, let me ask you, if given the choice, would you prefer to be able to buy stocks at $2.30 and sell at $2.40 as these contracts allow us to do? Yep. Yeah. Buy at $2.30, sell at $2.40. That would make sense all day long. Now, there's no guarantee that's actually what's ultimately going to happen. But if both of these contracts are in the money at expiration, that's almost certainly what's going to happen. Very few exceptions. So we want these contracts to be in the money at expiration, and they're already in the money. So if these get assigned, if we get assigned at $2.30 and we exercise at $2.40, that would be a $10 value from our $7.25 investment, giving us a maximum theoretical gain of $2.75. Now, this is a bullish spread because what we'd like is for the stock to, and if we want to, let's draw in our lines here. So we did the 230 and the 240. Actually, that's pretty close to where these lines are. But we have a 240 here. And we have a 230. It's really right on top of that. It's just a shade above that. Let me draw that in right here. That's going to represent our two strikes, okay? But if we're down here below that vertical spread as we get toward that April expiration, and especially as we get to that April expiration, if we're down here at $220 and someone has the right to sell shares for us to $230, are they going to do it? Yeah, with very few exceptions. Sell us those shares at $230, We sell them to somebody else for 240, $10 gain, minus the cost to set this deal up. That's what we want out of this trade. What we do not want is for this to happen. So if we get a really sharp rally, let's say the S&P decides, hey, 10% is enough, and it starts to rally, and it drags Lowe's and everybody else along with it. Not everybody else, but it's sort of exaggerating that point. But a lot of stocks go up, and if Lowe's rallies up, in that case, somebody has the right to sell shares to us for 230. Are they going to do it if those shares are worth more? No. Not. They could if they want to. They just probably won't. And if we have the right to sell shares to somebody else for 240, but they're worth more than 240, are we going to do that? No. That winds up being just blown money. We lost that investment. So Ed's saying, can we analyze this? We like to see the Analyze tool. I'm a fan of the Analyze tool, but not always as a teaching tool. It's kind of like if I were teaching, let's say, a math class, and I said, hey, let me show you this cool tool. It's called a calculator. Plug it in. There's the answer. Sometimes seeing the answer doesn't really teach us the lesson, right? So you'll notice I don't use that Analyze tab very often unless I'm teaching how the Analyze tab works, because I think it can sometimes help, but it can sometimes skip over a lot of the learning. Did I say bullish? I hope I said it. Yeah, this is definitely a bearish trade. Definitely a bearish trade. It is a bearish put spread. Yeah. So my mistake if I misspoke there. In any case, let's put on our bearish trade and see what we need to do in the future with the management of it. But a quick way to place these sorts of trades are to switch our spread from single to vertical, and then click on the ask price for the strike pair that we were interested in. There we go. So that looks like it's around, so we calculate about 725, might cost us more than that. Let's say it costs us significantly more than that. I'm going to dial that maybe all the way up to, let's say, let's maybe see if we can get in for $8. There is definitely some width here in the spread between the bid and the ask price as Lowe's is moving rapidly. But let's click confirm and send. Let's see if we can get into this for $8. That would be an $800 risk. Actually, for this webcast series, we typically do a greater risk than that. Let's do 5 of these. That would be a $4,000 risk if we fill. Buying 5 of these verticals, 240, 230 put, we're going to try to get in for $8. That will leave $2 for reward, or in other words, $4,000 invested, $1,000 of reward potential. There is a commission on this trade. Let's send that order off and see if we can get it filled. And we did. Look at that. It's filled at 720. Okay, I calculated 725. So it was actually pretty close to this original scenario. Just a little bit lower investment, a little bit higher potential reward. But guys, we're going to follow up on this trade in a future webcast, well, in each of our future webcasts until it's done. But it's an interesting place that we find ourselves on the markets. The S&P has officially entered correction territory. Let's see where it goes from here. We've made the decision as a group to trade bearishly. Is that the right decision? Time will tell. But guys, we've managed our existing positions, looked at the markets as a backdrop, placed a new trade, check, check, check. Time for me to let you go enjoy the next webcast coming right up. But before you go, just remember we have some other resources that you should take advantage of. First of all, do make sure that you've subscribed to our channel. You can go down below the video stream and click on subscribe. If you haven't done that already, subscribes you to the channel. That's where you can find our playlist for previous webcasts. You can join our live streams here. So Trader Talks Schwab Coaching Webcast is what you'll look for. Also, make sure that you are following Ben and me on X if you have an X account. So you can find Ben there at Ben Watson CS. You can find me there at Cameron May CS, but it's the best place to connect with your favorite presenters in between the live streams. Thank you to everybody that's already clicked the like button. That always helps. It sounds like applause to your presenter. And it also, it just gives a boost to the presenter's webcast in the YouTube algorithm. So Thank you for the 55 likes so far. Definitely appreciated. Finally, make sure you fill out that survey. Yeah, give me some feedback. Did we have a survey? I thought we had a survey. Yeah. In any case, anytime you see a survey, if you would fill that out, if you have the moment, it's always appreciated. It always helps. But everybody, go enjoy the rest of our webcast. I'll see you in a future webcast of mine. I'll also look for you on X, but whenever I see you again, until that moment arrives, I want to wish you the very best of luck. Happy trading. Bye-bye.